Hi everyone, welcome to Anu's classroom. In this video, we'll be discussing about few important questions and their potential answers from MMPC 14, that is financial management. It is a semester 2 paper, and in this video, we'll be discussing the important questions and answers from unit 1. So the first question in this video is write in brief the scope and functions of financial management. So, what is financial management? In short, financial management is the management of finances of a firm. Now, we know that no firm can operate in this world without having adequate finances to back them, right? You might have a wonderful idea, but if you don't get the finance that is required to kickstart your business, then you will not be able to make it into a business, right? Your idea will stay an idea itself. So, finance is required to start any business. You can say it is the backbone of any kind of business, correct? Now, the thing with finance is that it is a very scarce resource. Now, you just ask somebody to lend you some money to start on a business, or if somebody asks you to lend them some money to start a business, your first point of thought will be like, oh my god, that money is going to go only because I don't know how this guy is going to utilize that money. Most probably the you will be giving the money thinking that it is gone for good only, right? That is the thought that everybody is apprehensive, everybody is skeptical about giving money, especially to a newbie to start a business, right? In case that person is already well established, then we might be thinking, okay, he has proven his mettle in this business world, so maybe that money I'll get it back. That would be the thought. But especially if it is a new person, it is very difficult for us to actually source the amount of funds that we would need to start this business. So therefore, financial resources or finance is something that is very scarce to come by. So what happens with the scarce resources? You should be very careful in how we can use them, right? It's the same goes for finance in a business. Therefore, we should be knowing exactly how, why, and in which way we have to manage this very scarce to come by financial resources, which is essential to the sustenance of our business. So let us look at the scope and functions of finance management. Definitely, the scope would be to determine the funds that are required to run this business. It could be the initial setup or the daily operating funds, right? So, fund requirement could be for the initial assets like the procuring the land, machinery, building, all sorts of things, and the daily operational funds that we will require. Determine the assets that are to be acquired or how we can deploy the fund, right? Now that you got maybe say 1 lakh rupees by asking your friends, and whatever money you had, you might have pledged the gold of the women in the house. Maybe you've taken some loan from a bank. Well, taking loan from bank is a different story. You're not going to get it easily, but somehow you have borrowed some kind of money from some people, okay, with a rate of interest or whatever. Now that you have the funds, now you need to properly analyze how much money should be spent where, or whether you need to get a 10,000 rupee printer or a 50,000 rupee printer, depending upon your business. Okay, so or whether you need to get a Tata Innova, or whether you just need to buy a second hand Maruti 800 to commute, right? All these different decisions has to come in picture now in order to properly utilize this 1 lakh rupees, in order to gain the maximum benefit out of it and kickstart your business, right? So that also comes under the scope of financial management. Determine the activities or pattern of financing the asset, like how much money should I borrow from maybe what you can say a loan creditor, right? Or how much money should I borrow from my friend? How much money can I ask my parents? How much can I withdraw from my PF? All sorts of things. How much personal loan can I take? Such things come up, right? The determining the activities or pattern of how to finance these assets. Similarly, should I give ready cash, or should I go for a credit system, or should I go for a loan in buying these assets? All sorts of things come into picture. What are the functions of financial management? There are two different you can broadly divide the functions into two, that is routine and managerial. Routine functions include the functions that you do routinely, that is on a day-to-day basis or in a set cyclical fashion, like every month end or at the beginning of every financial year, whatever. That is a routine function. It could be supervision of the cash receipt, payments, cash security, safekeeping and custody of all the important documents and securities, taking care of your financial procedures, report preparations, record keeping. Those are the routine activities, the daily operating activities, you can say. Then comes the managerial activities of financial management. That is, again, raising and deployment of the funds, management of any surplus or deficit funds, cost management, taxation related management, all sorts of things come under the scope and functions of financial management. So, if you like our content, if you find this is useful, consider subscribing to the channel. It will help me also to grow and give you more and more content, similar content coming in the future. We have videos for semester 1 subjects as well as right now we are starting for the semester 2 subjects also. So consider subscribing if you like it. Do share with your friends as well. Let us move forward in our discussion. Distinguish between profit maximization and wealth maximization of a firm. Now, when we talk about profit maximization and wealth maximization, when you set up a business, you will be facing two different objectives of what you want to attain with this particular firm, right? One would be profit maximization. Now, what is profit? To know about profit maximization, we should know about what is profit, right? Um, Suppose, say, you need 100 rupees to manufacture a particular product. Okay, so this is the cost associated with that particular product. If you can sell it for 150 rupees, that is the price as 150 rupees, and you can sell it for it. The difference between the cost and the price, that is 50 rupees, is your profit, right? Now, the firm could be oriented to maximize the profit. Or what is the wealth maximization? What is wealth? Wealth, or you can think of it as the value, okay? That is maximizing the value of the firm or the wealth of the for the shareholders. That is value maximization. Ultimately, profit maximization, I would say, is a very limited or a very short term goal. Yes, we need profits, but a firm is not supposed to be oriented just for making profits. If your firm is just trying to make profits by cutting costs and pricing your products very high, then after a point of time, especially with the kind of competition that we currently have in the market, the problem is that your customers will find some other company that could give them the same product at a lesser cost, and you will start losing your customers. So, profit maximization, when you think about it in that sense, is a very limited goal. But in case you are trying to maximize your profits, then we should be going for those actions that increase the firm's profit and avoid the actions that reduce the profit. The limitations are there is ambiguity. How I define profit and how you define profit, it is different. It ignores the timing of benefits. Timing of benefits is the time value of money actually. So the profit maximization concept, it totally ignores the time value of money as well as the quality of the benefits that we are getting. Okay, is it just money, or are we also creating a goodwill? Are we creating a positive impression in the minds of the customers? Otherwise our customers will think, okay, these guys, their products, they are highly priced, but they don't have that kind of quality over there. Means it is the quality of benefits that we are getting is actually less. Why? Because it's going to diminish in the near future because people don't have a goodwill about us or our products in the market. Now, coming to wealth maximization, naturally, we have to think of, we will be doing all the activities that could increase the firm's wealth, whereas actions that could reduce the firm's wealth will be avoided. It aims at the prosperity as well as perpetuity of the company by helping to measure the performance of the company, allocation or reallocation of scarce resources, discharging other responsibilities effectively, like consumer protection, payment of fair wages, etc. So, the overall value of the firm is what we are trying to improve. And when the value of the firm increases, naturally, the wealth of the shareholders will also increase, right? If the firm that we are a shareholder of, or the firm that we are an owner or a proprietor of, if that firm is valued at, maybe we started it at 1 lakh rupees, and if the current value of that firm is along with all the products, all the the fair market value, or the true value of that firm or the book value of that firm, it is say for example 5 lakh rupees, then ultimately what is happening is that as the owner of the firm, my wealth has increased, right? From 1 lakh rupees, it has increased to whatever portion of, say, I had if I am the sole proprietor and I created this business and it is worth 5 lakh rupees now, and I only invested 1 lakh rupees maybe last year, then the entire wealth of the firm, the value of the firm, and therefore my wealth has increased, right? If I were to dissolve the firm, liquidate it, I would get 5 lakh rupees in return. So that is the whole wealth maximization concept. And this is ultimately the main aim of any firm should be to maximize its wealth. In what ways is the role of a finance manager different from that of an accountant? What we should understand is that we have studied about accounting in the first semester, MMPC 4, accounting for managers, right? What all things did we learn over there? We learned about the different kinds of accounts, why accounting is important, how to prepare the various books of accounts, what is cash flow, what is balance statement, and such things, right? Mm. Now, actually, you can think of this financial management as kind of like an extension of your accounting for managers or quantitative analysis paper. Okay, this is kind of like an extension, and we will be having a lot of concepts in this which are derived from accounting for managers or quantitative techniques. So, you can think of finance management as something that starts from where you have left in accounting. Accounting, the outputs of accounting, the reports and everything that come out as part of your accounting process is what is used as the inputs for your finance management, whether it be your pricing decisions or your budgeting decisions, whatever it is. You will be taking inputs from the accounts department to do that. So the accountant's job is to emphasize on the recording as well as reporting of the flow of money through the financial statements. Whereas financial managers or financial advisors, they oversee an individual's or organization's assets and liabilities and help them reach those goals. Accounting gives the inputs that are needed for the financial decision making. Financial decision making starts from where accounting ends. Now, the major two areas of difference between finance management and accounting is on how the funds are treated as well as how decisions are made. In accounting, measurement of funds is based on the accrual principle, whereas financial management treats the funds based on the cash flow. So, in accounting we prepare the cash flow and that is used by financial managers. That's what this means in the treatment of funds. Decision making, accounting is concerned with the collection and presentation of this financial data, right? It is not involved, accounting is not used for accounting. Accountants don't do or make any kind of financial decisions, but the results of what the accountant is preparing, that is used in financial decision making. So that is what is decision making is talking about. The primary role of a financial manager is financial planning, controlling, and decision making. And how does he plan, control, or make decisions? Using the inputs, that is the financial statements, the balance statement, the cash flow statement, the income statement, the profit and loss account. Using the figures over there, using the information that he can or she can get from there, the decisions are made, plans are created, controlling is done. The controlling is in budgeting, right? It is done. So that is how a finance manager differs from an accountant. What are the finance functions? Explain their importance and relevance. So what is a financial function? It is a managerial activity that is involved in the planning and control of a company's financial resources to achieve returns on invested capital. In short, it ref- resol- it it encompasses all the activities that are related towards determining how much fund is required, acquiring those funds from various sources by evaluating all the available sources of funds and their advantages and disadvantages, and utilizing whatever funds were acquired in order to gain what you can say maximum value addition, right? So that is simply the finance function. The main purpose or the importance of finance function is in order to provide the financial information that other business functions would require to operate effectively and efficiently, as well as support the business planning and decision making. The relevance of financial function comes in the fact that it helps in the financial planning, assisting the acquiring and managing of funds, and achieving the economic stability that is very much required for a firm to sustain itself in the market, help fund allocations, provide insights to make critical financial decisions, cut down on the financial cost, improve the profitability as well as value of the organization. So these are, as you might have understood by now, these are all recurrent concepts only, whatever we are saying, but it's just that they are framed a little bit differently. Therefore, we are presenting it in a little bit different manner. That's it. Next question, discuss the role of a financial manager in corporate business enterprise. So again, it is the same thing. Estimate the capital requirements, maintain the liquidity and solvency, estimate the risk and propose alternative risk reduction strategies. Decide on the dividend policies of the company, arrange for internal audits to be conducted, meet the legal duties as per law, report to external agencies like the government or tax authorities and such. Okay. Next, what is the nature of risk return trade off faced in financial decision making? Now, to understand this, we need to know what is risk return trade off, right? What is risk return trade off? Well, risk and return, they go hand in hand in any kind of investment, right? Let us take an example of two most common ways of investments that we would make as a common man. The first kind of investment we would make is maybe we would deposit our money in banks, right? Either it could be as a in our savings account, or we could create an FD, or some people might be doing an RD, that is recurring deposit, right? Or SIPs, or we could put that money in the market, stock market, right? So let us consider these two things, okay? Depositing in bank or stock market. These are two different ways in which we could invest. Now, when we deposit in bank, if it is in a savings account, we would get some amount of interest on it, which is much lesser than fixed deposits, right? What is the difference over here? When we are putting our money in savings account, then at any point of time, without any charge, if we have that money, we'll be able to withdraw it, right? Whereas in FD, there comes a lock-in period, but still at the end of the lock-in period, you are assured that you will get so and so amount of money in that is with that much amount of interest along with the principal amount that you give, right? Until and unless if your bank is not dissolved, that is your bank has like ceased to exist by the time your FD matures, you are sure that you will get back that much amount of money. What is happening over here is that your risk is minimal, right? And even if that risk is there, even if your bank has dissolved, even then up to 1 lakh rupees as per RBI mandate, you will definitely get back. So in case your FD total amount of FD is coming to below 1 lakh, then you can think of your risk as absolutely zero itself, right? And therefore the return that you would get from a FD or a savings account, that is very minimal, right? It is very meager only. It doesn't even cover the inflation. But when you think about it, if you are investing in stock market, definitely even mutual funds, you will find the clause, right? Mutual fund investments are subject to market risk. Please read the offer document carefully before investing. Though they're saying it in a very fast pace, this is what they're saying, right? So why do we invest in stock market? Why do we invest in mutual funds? It is so that we will get a much better rate of return than a conventional traditional FD, right? So what happens with that mutual fund or that stock market, or some ULIP plans which are linked to the market, is that the risk that we are taking over there is high. There is a much bigger chance of losing our money than the traditional FD or savings deposits, right? So the risk is high. So naturally we expect that since we are putting this much amount of risk into this particular investment, we need a higher rate of return as well. If you're putting your money in mutual funds and you're getting a return that is lower than your FD, will anybody be interested in putting it there? Nobody, right? Everyone will definitely choose FD only. So that is the risk return. That is the relationship between the risk and return. Now, the question is to talk about the nature of this risk return trade off that is faced in financial decision making. So, the risk return trade off, it states that the potential return rises with an increase in risk. And using this principle, individuals associate low levels of uncertainty with low potential returns and high levels of uncertainty or risk with high potential returns. And according to this risk return trade off, invested money can render higher profits only if the investor will accept a higher possibility of losses. If we are ready to accept the risks that come up associated with trading in the stock market or investing in mutual funds, only then we can expect that, okay, if things go well, then we will get maybe 15 or 20% return or even 10% return on our investments, right? So a healthy balance between this return and risk should always be maintained to optimize the market value of the firm's shares. You can think of return as equal to risk-free rate plus the risk premium. So risk premium is the amount of money we are expecting because we are taking that risk, and risk-free rate is the amount of return that we would get in case the risk is absolutely not there. So that's what I said. If we are putting in stock market, then and if the existing prevalent FD rate is say 4%, then 4% would be your risk-free rate plus maybe some amount of percent more for your risk taking, right? That is called as the risk premium, and combined with these two will get you the actual return on your investment. Okay, next question is discuss the problems of finance manager in the management functions in the Indian context. So some of the problems are like small teams, embracing new technology, providing real time data, communication, the rules and regulations and compliance. Maybe firms nowadays have too much debt, not having proper reporting structures, managing of cash flow, budgeting problems, the internal audits, the problem of performance, not being able to raise enough capital, roles and responsibilities of the financial advisors, problems with delegation of authority, and such. So you can think of it as like currently with globalization, there are a lot of competitors in the market. There is technology is going in a fast pace, right? Then there are shareholder activity nowadays. If we have invested some amount of money somewhere, then we are very keen on it. Rather, and we have the means also to communicate and see and get involved much more in the activities of the business than it was possible earlier without these much technological advancements and such. And then the changing taxation policies right now after GST was introduced, definitely their finance team would have faced a lot of problems in how to include GST, how to adapt to the new GST policies and such. So all these things are different problems or challenges, you can say, that a finance manager would be facing right now in the Indian context. You can add points as per your understanding as well. Now, explain the nature of finance function and discuss the approaches of finance management. So, this is a very important question. It had come up as one of the questions in the last June 2022 MMPC 14 paper. So, the nature of finance function we have already discussed earlier. It is the most important. Finance function is the most important of all the business functions. It starts with setting up of the enterprise and it will remain at all times. It is concerned with the acquisition, deployment, and utilization of funds that are needed for the organization to remain functional as well as growing. Hence, it is related to the overall management of the organization. Now, there are two approaches that are being discussed about for financial management in our textbook in Unit 1. The first approach is the traditional approach, where the scope of finance function was confined only to the procurement of funds that are needed by the business. So, according to the traditional approach, the role of the finance department, the CFO, was to get whatever funds are required for the smooth functioning of the other departments and other activities of the organization, whether it be the investment activity or the operating activity. Whatever fund is required, the finance department has to get. That was according to the traditional approach. But right now we are going through the modern approach, where finance department or financial management has to take care of both raising the funds as well as the effective utilization under the purview of finance. Okay, so that is the modern approach. So these are the two these are the two approaches to financial management. So these are the few important points with or important questions that I've come across in terms of Unit 1. We will discuss as many units as possible in the upcoming videos as well. I have divided the important questions unit wise. We will discuss the important questions of the upcoming units in upcoming videos as well. If you like the content, consider subscribing to the channel, share it with your friends as well, so that they can also make use of these videos in scoring good marks in your IGNOU examinations. All the best for the upcoming examinations. See you in the next video. Bye bye.